once you have posted your adjusting entries, the next step is to journalize closing entries and then post the closing entries to the general ledger. There are two kinds of accounts that we work with in the general ledger. We have our permanent accounts and our temporary accounts. Permanent accounts will always have a balance from one accounting period to another. Permanent accounts are assets, liabilities, and owner's equity. Temporary accounts are revenue, expenses, and the withdrawals. So we're going to go through the steps in this segment on how to journalize the closing entries and then posting them. So I want you to look at the steps on the order that we are going to close certain temporary accounts. The first one we're going to close is our revenue account. We will get these amounts from the worksheet or the general ledger. We have a new account called income summary. It's like a clearinghouse for all the amounts to go into, and then what will come out is either net income or net loss. So we first close our revenue into our income summary. Second step, we will close all the expenses into the income summary. We will find the balance of income summary, which will be the net income or net loss on the worksheet, and we will take that amount, put it into capital. The fourth step is to close a withdrawals account and subtract that amount from the capital. So let's go through and look at the steps. Here is a worksheet. In this worksheet, you will see that they have closed the accounts. All the temporary accounts are on the income statement. So we see our revenue, all our expenses, there is our net income, and there is our withdrawals. So let's look at the first entry. The income statement section of the worksheet shows that the word processing has a credit balance of $8,000. So if it has a balance of $8,000, to close it and get it to zero, we have to debit it $8,000. So our journal entry would look like word processing fees debited, income summary credited. Then we would post that to the general ledger, and here's a T account to illustrate that. And the debit to $8,000 to word processing fees gets this account to zero, and we're going to close it. Now the income summary is credited $8,000, and we will find the balance of this account and close it in step 3. The second step is to close all the expense accounts. We do this in one journal entry. We debit income summary for the total of all of our expenses. So you would write income summary, then start listing each expense and credit that expense because they have a debit balance, and with the credit amount it will get it to zero. List each expense, credit, each expense, credit, each expense. These are the balances of these accounts that you are crediting. Rent expense, depreciation expense. I would add these up, put the total amount right there. Income summary would then be debited for $3,100. Step 3, then here it shows you what it would look like when we post that journal entry. You will notice office salaries expense will be closed or have a zero balance. Telephone expense will have a zero balance. Rent expense. Here it shows that step 2, it's now income summary is debited for the $3,100. Advertising expense is closed, office supplies, and depreciation. Step 3 is where we're going to find the balance and income summary and move it to the capital account. So my income summary, here's my revenue, here's my total expenses. I find the difference, $4,900, and it's on the credit side because $8,000 is the largest number. This amount should match the amount on the worksheet for net income. So I'm bringing the worksheet back. There is your net income, $4,900. So the net income is being transferred into the capital account. So income summary is debited. That will get this account to 0. And the capital is credited, $4,900. We're going to take and clear out the withdrawals account. So I go to withdrawals. It has a debit balance of $625. So I'm going to credit withdrawals for the same amount and debit capital for $625. So the capital account then will have $10,000, $4,900, and then it will be debited $625, and you will find the up-to-date balance of the capital account, which should be the same as the last owner's equity capital account on the statement of owner's equity. Here's a summary of all the closing entries. The first one is revenue. Second entry is all the expenses. Third one is closing out income summary and putting either the net income or net loss into capital. And the fourth one is closing the withdrawals account and taking that amount and putting it into capital and subtracting it. So let's review. The purpose of closing entries is to close the temporary accounts. We're going to close revenue, expenses, and the withdrawals account. When you close an account, you make an entry that will get that account to a 0 balance. This way, when they start a new accounting period, these temporary accounts will be able to collect all the revenue and expenses that occur in the new accounting period.